friends. Welcome to the Skinny on Wall Street with us, the Wall Street Skinny. I'm Kristen.
I'm Jen.
All right, so what do we have on the docket for you today? So Jen is going to kick this off. I guess like payrolls were revised. And so that's a big story that's going on in the markets. So she's going to give us the skinny on that. And last week, if you didn't listen, we talked about the ruling that Google was a monopoly and the potential remedies, one of which might be that Google may have to be split up. As well as we discussed this deal that was announced last week where Mars announced that they were going to acquire Kellanova. And so we got into this whole discussion about spinoffs and split-offs, as well as why would a company decide to use cash versus stock in an M&A acquisition. And so and we wanted to today is basically a part two because it was funny, actually. My husband, he came home after he listened to it. He's like, you never actually really explained why Mars decided to use cash. So I was like, oh, okay. So we're going to do a slightly more technical deep dive into some of the considerations that companies have when they decide, should I be using cash, stock, or a combination in a merger? And by the way, actually, if we seem a little frazzled this morning, I was working this morning and then out of nowhere, my power went out. But it wasn't just my power. I couldn't text. I couldn't Google. I was trying to look up the power company. I tried to text my neighbor to see if they had power. It didn't go through. So I ran over to their house and they were like, I can't text anyone either. It was
But
wild.
Weirdly, the only thing that worked was your phone calls to me.
Was my phone, which my phone never works. Usually Jen and I are on the phone together and it's like dead spots, or people call me all the time and they're like, I called you 5 times and I can't get through to you. So I don't know what's been going on. It's been a crazy morning. So anyway.
And I'm here in my old recording studio. This is where I used to record our early episodes because it's the quietest room in the house. But my neighbor decided to put a new roof on their house today. So congratulations, neighbor. But yeah, there's shingles flying and debris and so much noise in my office. And you guys, if anyone watches the video of these podcasts, it's rare that I'm recording in the same space with the same lighting, with the same camera setup for more than a day in a row. I'm all over the place. Kristen is very steady, very consistent. Yeah, exactly.
Yeah. I just sit here yelling about the trumpet next door. But yeah.
Oh, yeah, you and your trumpet. Okay, so let's talk payrolls. So we've discussed the non-farm payrolls report and the Bureau of Labor Statistics on here before. So I don't want to rehash all of that. We have a good, when we used to do our skinny minis before we figured out the skinny on format, we had a good episode a couple months back explaining the importance of some of the labor data for the Fed's dual mandate of maximizing employment while also keeping price stability, aka keeping inflation in check. So the employment side of that picture is really important for the path of interest rates. And that's why we care so much about all jobs data. And what'll happen is whenever they release data, they release it and then several months later, there will be revisions, right? And we get revisions on a monthly basis, and then we get kind of annual revisions and rolling revisions on all this jobs data. And so yesterday, the Bureau of Labor Statistics was supposed to publish at 10 a.m. the revisions to the 12 months of payroll data ending in March. And that was supposed to come out at 10 a.m. And as we've discussed on here before, when you have a data release that's very important, every trader around the world is pretty much sitting by their computer screen and they know, okay, if this comes in higher than expected, lower than expected, this is going to mean something for my positions and I am going to make a trade based off of this new information. So these are market moving events. 10 a.m. comes and goes, nothing happens. There's no data release. So all of a sudden then there start to be some big moves and people are like, do they have where's the report? Blah, blah, blah. Half an hour goes by. And what had happened was a few banks, I think it was Mizuho, Nomura, and BNP, called the goddamn BLS and was like, hey, do you have this data? And they're like, oh, yeah, it's down 818,000, which, by the way, is the largest downward revision since 2009. That's almost 1 million jobs that were reported that are now missing, right? So
how does that happen?
But, well, there's a whole number of technical factors with the data that we can get into. But the really important thing was twofold. A, that's massive incompetence, right? That this data was supposed to release that the market is waiting on. It's not like with Kristen and me being like, oh, you usually put out a podcast on Wednesday, but you put it out on Thursday. No one is sitting, living and dying by the release of the Skinny On podcast. Okay. If we put it out on Wednesday or Thursday or Friday, you guys don't really give a shit. But like, this is really important economic data from a government institution. And they like, oh, whoops, fumbled the ball. Like, blame the intern, right? Like, yeah, exactly. Pound ref. So there was that. Number two, there was the fact that some banks actually had the presence of mind and the hustle to like make a call and be like, hey guys, where's this information? And they got it and they traded on it based on getting that information, right? So that's another huge problem. And there have been reports recently. I think there was a report last month about members of the BLS communicating about CPI data with certain financial institutions outside of the scope of just the data, being like, oh yeah, well, this is showing. And it's like, oh, that's not publicly available information. There's a huge problem there. And as we've seen with kind of the theme of the past, I don't know, 10 years politically, like however long you want to go back. Sorry, fuzz. There has been a growing lack of faith in American institutions from the public writ large. And payrolls has always been one of those things. There were skeptics on the trading floor in 2006, 2007, 2008 when I was there who were like, payroll data isn't the same. Someone clearly has the number before the report comes out, right? There's always been that speculation of kind of wrongdoing. But there's also the added element of skepticism. And again, this is not based on any actual knowledge that Kristen or I have. But there's this added element of skepticism of like, okay, the past year, has the economy felt good to you? I don't think so, right? Are you hearing lots of friends who are like, oh my God, my new job is going so great. I'm getting paid so much money. Or is it like, hey, I'm really struggling to make ends meet with inflation and I just got laid off and I'm looking for a job and it's really hard to find one, blah, 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 right? So like you get these jobs reports and it's like, everything's great for 12 months. And you're like, gosh, that's just so different from kind of what I'm seeing out on the street, just talking to regular people and the vibes. Okay. The vibes have not been good. Well, there's always been this speculation that to the upside and the downside, that these economic data releases are artificially manipulated in one way or another to basically support whatever the economic policies are of the incumbent administration. And again, I'm not saying that we have actual knowledge of this, but when you get a downward revision of close to 1 million jobs, so close to the election, especially as the election dynamics are changing, it gives additional support to those skeptics being like, see, I told you, right? I told you these numbers
who
were
would
made
that
up.
benefit though? I mean, it's funny because it's like in theory, I mean, if you wanted it to be like a conspiracy theory, I feel like you should hold that and do it after the election. You know what I mean? Like
after someone's changed a policy.
No, it's just after the election. Be like, it's like when a new CEO comes in and it's like, oh, look at all the bad shit that like it was all them. So now it's everything's fine. And like, it's so anyway, I'm just saying it's like close to an election. It almost feels like it's the, I'm like, who benefits here? Right.
Well, and you can go, and that's why I'm not a conspiracy theorist personally, simply because I think that most politicians are too stupid to actually, exactly.
It's
to actually implement these wild conspiracy theories. I'm like, God, those conspiracy theories, you'd really have to be smart to implement those. And I just don't have faith in any of our politicians that they are that bright. But sorry, that feels a little bit rude. But I will say this, the reality with all of this data, it's also backward looking, not just in terms of the payroll data, but economic policies take so long to filter down through the transmission mechanisms. So the idea that even if the Fed moves, if the Fed lowers rates, right, the transmission mechanisms take time and they don't always play out in the ways that you'd expect. So even when there is a new policy course correction or decision made, it's not going to be instantaneous. And then there's going to be the revisions and there's going to be the knock-on unexpected effects. So to point to any one thing or any one administration or any one set of economic policies is fallacy in and of itself. But the reality is 2 lessons. Okay. 1, if you hustle and go to old-fashioned skills like picking up the phone, you might get the jump on the entire market on something. So like old-fashioned hustle and grit and like common sense still have a place in the world of algos and quants and all the traders who are going to get ahead of you on every single piece of information out there. And number 2 is information, like the availability of information. We become so complacent, right? That like, oh, okay, I'm just going to Google. And now when you go to Google, right, it's like AI summarizes all the Google results for you, right? We've talked about this a number of times on here, and especially traders, right? There's so much information coming at you all the time. How do you parse through that noise and look for signal? Well, okay, how do you also parse through that noise and know that whatever signal you get could be revised down to the tune of 1 million jobs 8 months from now? So you really have to be, yeah, you really do. You really have to be, I don't want to be one of those people who's like, do your own research, right? But think about the common sense. Think about what we were just saying about the zeitgeist and about kind of the overall vibe, if you will. Kristen's market vibes. Okay, that's what we should call our newsletter, vibes. But like the overall vibe wasn't jiving with the data. And sure enough, the data needed to be revised down to the tune of the biggest downward revision since the global financial crisis. So
that's wild. I will say it's crazy how reliant we are on technology. I was trying to call our power people and I'm like trying to Google, like, what is the phone number? And I couldn't Google it. And then this was the craziest part too, is then like people were calling them and it was like, the Verizon caller does not have a voicemail that has been set up. And it was like, nobody can get through to them.
That's such a good point. Your experience this morning is the microcosm for how reliant we've become on technology. I seriously feel like I'm forgetting Sarah Marshall here when she's talking about the plot of her movie where like the cell phones kill people and like, you know, they're like, oh, it's a metaphor for technology and society. And like the men at the table are just laughing at her. Whatever. Anyways.
All right.
But yeah.
Well, speaking of, and actually there is no good segue for that one. I guess actually there is because Google.
Yeah, there you
which
go.
By the way, I can't not call them Google. So I know
it's
they're
Google.
Alphabet, but
no,
they're
it's Google.
I'm going to be talking with them as Google.
I still call Meta Facebook.
Oh, I do too. And it's going to forever be, I mean, I still call you by your maiden name. You are in my phone as your maiden name and it is never going to change. In my head, that is you. So,
well, you're in my phone now as first year analyst. Thanks to that trail we filmed. Okay, sorry, I'll shut up.
No, it's all good. So last week, like I said, we were talking about two things that were separate and yet actually had a lot of similarities. So we were talking about Mars buying Kellanova and the fact that Kellanova essentially was born out of a tax-free spinoff from Kellogg. So Kellogg decided, hey, we want to split our company into basically two. And so they did this spinoff. And so then Mars acquired that company. Now, why the heck would a company do this in the first place? And the reason is that there is, usually it's called this conglomerate discount. So the idea is that when you have these large companies that have all these different like divisions and all these different subsidiaries and they do all these different things, they start to actually trade at a discount because there's less transparency. And so companies sometimes will actually elect to either sell off a subsidiary or to do some of these, again, it's called like these public market separation techniques where they, again, separate themselves into different public entities. And so what was interesting about that is at the same time, we were also talking about Google possibly being forced to do this by the government. But it's kind of like, I mean, honestly, maybe it's not the worst idea for them because it actually might benefit them to have different entities. And so, you know, as we think about if Google is actually forced to separate themselves, like how could they do that? So there's kind of two buckets of ways that you can separate yourself, right? That they could be split up. Either they could divest, so they could take a asset, they could take, call it, I don't know, let's pick YouTube, and they could decide, you know what, we are going to sell that. So we're going to sell it to somebody else. Now, I don't know that
they
anyone
own
could
like
actually,
everything.
I know, they own everything.
I was like, oh yeah, they own YouTube.
I would argue that it's going to be pretty hard for them to actually do that because what other company out there can afford to buy them / like if they sold to call it like a Meta or an Apple or somebody, I mean, like then they probably have a, I don't know, they might end up with some kind of monopoly issue anyway. Yeah. So the idea that they're going to divest through a sale, and by the way, they're probably not going to be divesting YouTube. They probably would pick a different division. But the point is I'm going to use it because it's a nice, easy example. So either they could sell a division or they could do one of these, again, these public market separation techniques. And so this is what we were talking about last week. The one that, again, Kellogg decided to do with Kellanova was this spinoff, but there's a bunch of different options. You can do something called an equity carve out, which is basically where you actually take a subsidiary public. Usually you're going to do in the order of like less than 50% of the subsidiary shares, like you take them public. So for example, Google decides, you know what, we're going to actually take YouTube and we're going to IPO it. YouTube would actually have to file with the SEC. They're going to have like financial statements. There's going to be public disclosure. So the reason that you might choose this over some of the other options is number one, the parent company. So Google would actually get cash if they did an IPO. So they're going to actually get, you know, proceeds from selling shares of the subsidiary. Number two, you actually this is not so much a reason to do this over some of the other options, but like if you do a subsidiary IPO, it does mean that now there is stock of the subsidiary that is publicly traded. And this actually can be helpful for two reasons. So number one, it is potentially helpful for management. If, for example, like YouTube is higher growth than Google, then
the search engine.
Yeah, then the management team at YouTube might be more incentivized because they're being paid oftentimes in the stock of then like YouTube versus Google. But then also YouTube then has its own acquisition currency that it can go out and it can use to acquire other businesses. And that's going to be something that we're going to get into again in a moment as we talk about like the M&A considerations and acquisition currency and all that. So having, again, a subsidiary that has publicly traded stock can be helpful in that case. The management, or I should say the benefit of, and actually this would be probably a reason why you would not see Google do this, is that Google would actually still maintain some control. So this is probably not on the table.
That was my question. Yeah. So they still maintain control.
It's not a full split. So this is not going to be what they would use. But again, as people start to think about the different types
because that wouldn't meet the monopoly requirements, right?
Well, again, assuming that the Justice Department forces them to be split up. Yes. So there is potential issues, but it does help with the conglomerate discount that we talked about because now they are publicly traded, people can see the financials, and again, it is now, like I said, there's benefits to that. So this is probably not going to be on the table for Google. What potentially would be is one of these split-offs or spin-offs. So spin-off is probably more common, and this is what we talked about was done with Kellanova. And so the idea here is, again, I'm going to use the Google example because I think that, like I said, it's just a better one than Kellanova. But essentially, if you have public shareholders, so you are a shareholder and you own Google stock, Google, right, one of their subsidiaries is YouTube. So what would happen in this spinoff is that, again, like now, the two entities separate, and you as a public shareholder would now own not only shares of the remaining amount of Google, but also you would now own YouTube. So you basically now own two different entities. As a previously public shareholder, you now are going to own both. Okay. So in theory, now these are both publicly traded. They are separate. That is, again, that would be a potential benefit. Obviously,
there's no control. There's no control overlaps.
No, but the public shareholders of, And so with the Microsoft example, Bill Gates and Steve Ballmer, they would have had to like divest from the other. So it is possible that like some of the management team might have to sell out if they were previously an owner. Like they may not be able to own both. But so that, again, I'm assuming if that happened, that potentially could be a remedy. But that's the spinoff. And again,
one question with a spinoff, you mentioned that the Kellanova spinoff was a tax-free spinoff. What made it a tax-free spinoff versus a taxable
spinoff?
So taxable. There we go.
Taxable. So there are rules that govern that. It's specifically IRS Code Section 355, in case anybody cares. And
Kristen had that off the top of her head. She's got it tattooed on the inside of her elbow.
Yeah, I got my notes here. So there are some requirements. The main idea is that the subsidiary has to be owned by the parent for at least a certain amount of time period prior. So in other words, Google like owned YouTube. They bought it. Oh my gosh, when did they buy it? I feel like I was still in college when they bought YouTube. I mean, they've owned it for a long ass time. There's a whole bunch of requirements, but the TLDR is there has to be a valid business reason for this actual transaction. And it can't be something where it's like you just bought the company like a year ago and now it's like, hey, let's do this. It needs to kind of probably pass the sniff test. As a non-tax expert, like this is my 2 cents.
Consult your accountants.
Yeah. Consult your tax authorities. Consult Ernst & Young and whoever else. Okay. So, but I do want to make the point that that's that spinoff. So with the split off, we talked about this last week, but I want to go through it in the context of this potential Google breakup. So you have public shareholders, they own Google, and then that obviously the parent owns YouTube. Now with the split off, what would happen is that the shareholders, if you are a public shareholder, you need to decide like if and how many of the subsidiary you want to own. So they do split, but you as a shareholder aren't going to now get basically shares.
You don't
in both.
Automatically get shares in both.
No. So if you want to participate in the sub, like you want to own them, you would have to basically surrender your shares of Google, and in exchange, you would get shares of YouTube. So,
okay. And then you could go back independently and buy shares of Google, but they're like Okay, so they're not creating something out of nothing. It's a zero-sum game to start effectively.
Yeah. So the number of shares of Google would go down as potentially investors who were Google shareholders surrender their shares, and in exchange, they get shares of YouTube. So
I see.
That also would end up resulting in, I believe, that full kind of separation. But so those are some of the, again, things that you potentially might see in the context of this Google example. And hopefully this makes a little bit more sense, as to like what the motivations are. Again, public companies do this all the time if they feel like they have this conglomerate discount, because you can unlock value by separating entities out. Now, the downside is it's kind of like, it's funny because when you have an actual merger, some of the reasons for the merger is synergies. Like 1 + 1 is greater than 2. And now it's like you get like reverse synergies. So now you are going to have extra filing fees. Like you are going to potentially not have the distribution network. So there is potentially some downsides to doing this. But obviously, if the government is making you do it, like you kind of don't have a choice. But it might not be necessarily a bad thing if they had to split up. So just something to think about.
No, that makes a lot of sense. Okay, and let's go back to Mars. So talking about acquisition currency and the decision to use cash instead of selling ownership stakes. I'm really curious for you to unpack that a little bit more.
All right, so I actually want to back up a little bit, and I want to talk about companies deciding to issue debt or equity in general if they need to finance themselves. So when I used to work on the converts desk, it was funny because we used to have these conversations with companies all the time, because one of the reasons why you might do a convert is there is the benefit and
for our listeners, can you explain what a convertible bond is?
Yeah, so converts, and so you can have convertible bonds, convertible debt, you can have convertible preferred, but essentially what it is you have, and I'm going to use the bond just because it's more, I feel like it's more common. Yeah. So if you are buying a convertible bond, you are buying debt that's going to pay you interest. However, if the share price of the company gets above some threshold, you can decide to convert your debt into equity. So you become a public shareholder instead of being a bond owner. Now, the benefits, I should say, to being a convertible investor or just debt in general is you have the downside protection because it's a bond. Like if the company goes bankrupt, you are more senior in the capital structure, right? If the share price doesn't do well, you can basically get back par. So you invest $100, you can get paid back $100 in, call it 5 years, whenever it matures. So you have the downside protection, but you also have the upside, meaning the share price as well. You participate in that upside. Obviously, you're not going to have the same amount of upside participation as if you bought equity outright, right? It's a trade-off, but you do have that upside benefit. And so when companies used to come to us, one of the things that we would do is we would basically create these like cost of capital diagrams where we would show them, if you were looking at a graph where the y-axis is the cost, the x-axis is this, what we expect is going to happen to your share price. So this is the CAGR you expect over the next 5 years. And so straight debt, if you think about what is the cost relative to the share price, it's not a function of it. It's literally like a horizontal line. Unrelated. It is not, there is no relation whatsoever. Equity, on the other hand, has a perfect relation. The more the share price goes up, the more, again, costly it is. So basically, it is a horizontal line for debt. It is a 45-degree upward sloping line for equity. And then convert is basically a little bit lower on the bond side because you're not going to get as high of an interest rate. And then you do get the upside benefit, but not as much as equity. Okay, cool. So that's part of the thing that people think about is like, what's the cost? The other thing people care about is what happens to their earnings per share, especially if they are a public company. Now, why do people care about EPS? They care about it because most equity investors trade off of expected EPS. I mean, it's not exactly a perfect correlation, but your share price is more or less your price to earnings ratio times the earnings per share. So if your EPS goes up, the share price in theory should go up. So companies really care about their EPS. And if we think about what is earnings per share, by definition, it is net income over shares. So if you think about, cool, like if I raise debt or equity, how does it impact these two things? Well, if you issue debt, that is going to impact your net income in the form of interest, right? Your net income is going to go down. It's not going to impact your shares at all in the denominator. But if you issue equity, it's going to have a huge amount of impact on your shares, but it's not going to impact your net income at all. So the point is that as you think about what happens to my EPS, there is that trade-off. Now, for most companies, issuing equity is going to be more what's called dilutive, meaning if you issue equity, because you now have this giant gianter. You have a larger number in the new denominator. It's
you have more
going
shares.
to typically be worse, than if you had essentially financed everything through debt, but that's not always the case. And so now, as we hopefully understand, like the two main considerations that companies are often thinking about is like, okay, what's the cost / like what is the impact on my earnings per share? So in M&A, companies oftentimes are going to be very focused on that share price if you are a publicly traded company. So as we mentioned, there is that trade-off between debt and equity. And so for most companies, you'll see that borrowing debt probably is going to result in more accretion, but that's not always the case. So if you have a company that has very valuable acquisition currency, you might actually see a situation where if they were to issue new shares, it is going to benefit their EPS more than if they borrowed debt to finance the deal. So the point is that as you're looking at public companies, again, there is that trade-off between the value of your acquisition currency in the form of stock and how expensive it is to borrow money. That is what happens to the income statement, but that's not the whole picture. There is also the consideration of like, well, what happens to your balance sheet? Because there's only so much money you can borrow.
Yeah.
And by the way, ownership, giving away ownership, right? That is not only dilutive to your EPS, that's actually dilutive to ownership too. So it's not as simple as saying, oh, I'm going to look at what happens to EPS and call it a day. No, you might have constraints on your debt capacity with
on leverage. Yeah.
And you might also feel very strongly about not wanting to give up control. So
especially if you're a private company like Mars, like there's a whole point. You've stayed private forever. It's like notoriously one of the longest privately held companies in America. Like clearly they don't like giving up ownership, right?
So they probably, I mean, again, if they have the balance sheet capacity, they probably are going to be like, we're going to do deals in cash all day, every day. Like why the heck would we do anything else?
Yeah.
So, I mean, for a company like Mars, I mean, that's a pretty obvious thing. But again, if they came to like some balance sheet constraint where they're trying to borrow money, they want to do this massive deal and they are not able to get there on the price as they're negotiating with the seller, then it might make sense for them to say, okay, we're going to do some ownership. Or maybe the seller really wants, like in order for them to agree to the transaction, they want to have ownership in this combined entity going forward.
Yeah.
So maybe they say, we're not interested unless you give us some equity ownership. So there can be, again, this is a negotiation. Like in an M&A deal, it's not a one-sided thing. You are negotiating with the seller who is also going to have some view. And this brings me to one last point. When a private equity firm does a leverage buyout, a lot of the times they actually do what's called rollover equity. So they want the management team of the selling company to, again, have ownership in the business going forward. So it is actually very common to see, again, this rollover equity, especially for like the management team when you have these types of deals. But again,
so how does that work? So how does rollover equity work?
Well, basically, if you are selling your business, you sell the business, but you're not selling 100%. So you're going to maintain, I don't know, whatever it is, 5%, 10% ownership going forward, right? The private equity firm would own, say, like 90%, 95%, but then management would own some percent, 5%, 10%, maybe more. And they can basically are going to participate in any of the upside.
Got it.
So that's it. It's just you're essentially rolling over your stake. So you're cashing out a significant portion, right? So you are going to, they offer you $100 million. You're taking some amount of that off the table, but you're not going to pay, you're not selling 100%. You're going to maintain some percentage in the business. And then that is, you participate in the upside with the
Well, and I think so many private equity firms are now using that as a marketing tool, saying, hey, this is how often we let, existing management stay part of the process, right? And stay involved.
A lot of times they want that. Yeah. It's obviously going to depend situation on situation, but I know you were talking about how, I think was it Ted Seide's podcast that you were listening to that episode and you were like, it's basically a giant ad for like, hey, if we buy your company, you'll get to
stay. Don't worry. We're not trying to kick you out. We promise.
Yeah. They took pride in how many CEOs, like they kept on board. It was 95% plus or something crazy.
No, but Kristen, that was so helpful because you are so good at explaining this M&A stuff. And it's funny because you've done this relative PE kind of Wall Street math reel a number of times on our Instagram. And so I always boil it down to that in my mind. It's like, relative PEs.
Yeah.
But like there is so much more nuance to it that I think many of us miss, right? In learning how to think to the interview and not learning how to think to the job. And I think realizing that there's so much nuance to the equation. There is how much leverage can a company take on? There is how much, how expensive is it getting? How much do I want to give away ownership? All those other things that go into it beyond just accretion dilution.
And then also taxes. Like that's another piece as well,
God.
which like is yeah. I mean, that's a whole other conversation with like
no, thank you. Already me asking that question about the tax-free spinoff already blew up my mind. Okay, so what do we have coming up?
So we have Ted on Saturday, which is going to be an awesome episode. I'm like so excited for that to release.
He's the host of the Capital Allocators podcast. If you guys aren't listening to that, I don't know what you're doing because like we're cool. But Ted, if you are interested in private capital, he has the best speakers on. He is an industry expert and he's got a third book on the subject coming out, which we both had to
private equity deals.
Sneak peek.
Well, yeah. I mean, anyone who's interested in private equity, that's what we talk about for the majority of the podcast is he actually, I believe, has a separate podcast in addition to capital allocators called Private Equity Deals. It's like a couple of seasons. And so he is an expert in that way beyond anybody else. Anyway, listen to the episode. It is a very good episode for anyone interested in private equity. And then next week, we have another very special guest coming up.
No, it's a great lineup here. We really appreciate you guys listening, and we're able to get better and better guests every month thanks to you and your support. And one last thing. So last week on Saturday, we talked about sending out a free resume template. If you guys have not subscribed to our newsletter, get on there now. If you subscribe to our newsletter or if you look at today's issue, if you're already subscribed, we have a free resume template that you can download. You can use it to your heart's content and you can go land yourself a job on Wall Street with it.
Yeah, and just was a resume template that was passed around Princeton and that Jen used back in the day. And I
used this to get every single job.
And in addition to I think what's special about this is you have a whole bunch of tips in it. It's very like straightforward. It's very easy to understand. And then in the email you get, Jen also has a video where she walks you through some tips. It's only 3 minutes. Honestly, it is everything. So highly recommend checking that out. It is awesome. Jen did a really great job on that.
Yeah. All right, guys. Well, thank you so much. We'll see you on Saturday.
Bye.
Bye.